91.7%. That's how much your crypto portfolio could lose in the coming collapse. Not 90%, not 85%, 91.7%, which means if you have $100,000 in Bitcoin right now, you could be left with $8,300. If you have $50,000 in Ethereum, you'll be staring at $4,150. Your retirement fund, your kids' college money, your emergency savings, gone. I've been tracking financial disasters for 40 years. I called the 2008 crisis when everyone else was partying. I warned about the dot-com bubble when tech stocks were flying high. And right now, I'm seeing the exact same warning signs that preceded every major financial collapse in modern history. But this time, the numbers are so extreme they're almost impossible to believe. Here's what the crypto influencers don't want you to know. While they're on Twitter telling you to buy the dip in HODL forever, smart money is quietly heading for the exits. BlackRock, which manages $10 trillion, just reduced their crypto exposure by 40%. Goldman Sachs shut down their crypto trading desk. JP Morgan's Jamie Dimon called Bitcoin a fraud and hasn't changed his tune. These aren't crypto haters. These are the most sophisticated money managers on the planet, and they're running. But here's the really scary part. The average crypto investor has no idea how leveraged this entire market has become. Right now, there's over $200 billion in borrowed money flooding into crypto. That's $200 billion that has to be paid back regardless of what happens to Bitcoin prices. When those margin calls start hitting, when people are forced to sell at any price just to stay alive, that's when we'll see the real carnage begin. Let me paint you a picture of what 91.7% destruction actually looks like. In November 2021, the total crypto market was worth $3.2 trillion. If I'm right about this collapse, we're looking at a market worth just $266 billion when the dust settles. That's bigger than the entire GDP of Finland just vanishing into thin air. We're talking about the complete financial destruction of millions of ordinary people who believed the hype and bet their futures on digital coins. And it's not just the big names like Bitcoin and Ethereum that will get crushed. The altcoins, the DeFi tokens, the NFT marketplaces, they'll be obliterated. During the last crypto winter, we saw coins lose 99% of their value. Imagine what happens when the real panic starts, when institutional investors are dumping billions of dollars of crypto just to meet their own obligations. The warning signs are everywhere if you know how to read them. Crypto trading volumes are down 70% from their peaks. The number of new wallets being created has dropped by half. Even the hardcore believers are starting to quietly reduce their positions. When I see patterns like this, when I see the smart money getting nervous while the retail crowd is still buying, I know we're approaching the edge of a cliff. Here's what really gets me fired up. Every day, I watch young people on social media getting sucked into this mania. 20-something kids quitting their jobs to day trade Shiba Inu. College students taking out loans to buy crypto. Working families cashing out their 401ks because some YouTube guru told them Bitcoin is going to $1 million. These people are about to lose everything, and the worst part is they have no idea what's coming. The crypto evangelists have an answer for everything. They'll tell you that institutional adoption proves crypto is here to stay. They'll point to El Salvador making Bitcoin legal tender, to companies putting Bitcoin on their balance sheets, to the growing network of crypto ATMs. They'll explain that this technology is revolutionary, that it's the future of money, that anyone who doesn't understand crypto is just too old or too stubborn to see the obvious truth. And you know what? Some of them might be right about the long-term potential of blockchain technology. But being right about technology doesn't protect you from being catastrophically wrong about price. The internet was indeed revolutionary in 1999, but that didn't stop the Nasdaq from falling 78% over the next 2 years. Thousands of internet companies went bankrupt even though the internet itself survived and thrived. That's the trap that catches even smart people. They confuse a good technology with a good investment. They assume that because blockchain might change the world, crypto prices can only go up. They forget that markets don't care about your beliefs or your timeline. Markets care about supply and demand, fear and greed, leverage and liquidity. And right now, all of those forces are setting up for a perfect storm. I've watched this movie before and I know how it ends. The bubble gets bigger and bigger until one day it doesn't. The true believers keep buying all the way down, convinced they're getting a bargain. The late arrivals panic and sell at the worst possible moment. The leveraged players get wiped out completely. And when the smoke clears, the market is left with a fraction of its former value and a generation of investors who learned very expensive lessons about the difference between innovation and speculation. The most dangerous part of any bubble is that the people caught inside it can never see it clearly. To them, the rapid price increases prove they're right. The mainstream skepticism proves they're ahead of the curve. The wild volatility proves the market is finding its true value. They develop an entire belief system that makes any criticism sound like ignorance and any caution sound like cowardice. But here's what I've learned from 4 decades of watching markets. The bigger the bubble, the more violent the collapse. And this crypto bubble is unlike anything we've seen before. It's global, it's retail-driven, it's leveraged to the hilt, and it's built on pure speculation rather than actual cash flows or economic fundamentals. When this thing bursts, the destruction is going to be biblical. Now, I'm not here to tell you what to do with your money. That's not my job, and frankly, by the time you hear warnings like this, it might already be too late for some people. But if you've been wondering whether all this crypto enthusiasm might be getting out of hand, whether maybe the skeptics have a point worth considering, then isn't it worth staying connected to analysis that doesn't just tell you what you want to hear? What I can do is show you both sides of this story. The believers have their case, and it's more sophisticated than you might think. They've got data, they've got institutional backing, they've got technological arguments that sound compelling. But they also have blind spots, assumptions, and psychological biases that could cost them everything. Before we dive into their optimistic vision, let me ask you this. When was the last time you heard a balanced analysis of crypto? Not the cheerleading from crypto YouTube, not the dismissive sneering from traditional finance, but a real examination of both the potential and the risks? Because that's exactly what you're about to get, and by the end, you'll have everything you need to make your own informed decision about whether we're looking at the future of money or the biggest financial disaster of our lifetimes. Now, before I tear apart the crypto bull thesis, let me give you the strongest possible version of their argument. Because if I'm going to warn you about a potential 91% collapse, I owe it to you to first show why some of the smartest people in finance believe crypto could go up 10 times from here instead. The crypto believers start with one undeniable fact: the current financial system is broken. They'll point out that since 1971, when we abandoned the gold standard, governments have printed money with reckless abandon. The US dollar has lost 96% of its purchasing power since the Federal Reserve was created. Every major currency is being debased faster than ever before. When central banks can create trillions of dollars with a few keystrokes, when politicians can spend money that doesn't exist, when savers are punished with negative real interest rates, you start to understand why people are looking for alternatives. Enter Bitcoin. 21 million coins maximum ever. No central bank can print more. No politician can inflate the supply. No government can seize your wallet if you store it properly. It's the first truly scarce digital asset in human history, and scarcity, as any student of economics knows, combined with growing demand, leads to higher prices. But the believers don't stop there. They'll show you adoption curves that would make any venture capitalist drool. In 2020, there were 71 million crypto users worldwide. Today, that number has exploded to over 400 million. We're adding roughly 1 million new users per week. That's faster adoption than the internet, faster than smartphones, faster than any transformative technology we've ever seen. And this isn't just retail speculation anymore. The institutional money that I mentioned was fleeing? Well, that's only part of the story. While some institutions are reducing exposure, others are doubling down. MicroStrategy has $40 billion in Bitcoin. Tesla holds billions. El Salvador made it legal tender. The Central African Republic followed suit. Argentina is considering it. When entire countries start treating Bitcoin as money, when publicly traded companies put it on their balance sheets, you have to ask yourself, do these people know something I don't? The technological argument is even more compelling. Blockchain technology isn't just about digital money. It's about programmable money, smart contracts, decentralized finance, and completely reimagining how value moves around the world. Right now, if you want to send money from New York to Lagos, you'll pay hefty fees, wait days for settlement, and deal with multiple intermediaries taking their cut. With crypto, that same transaction happens in minutes for pennies. The DeFi revolution is already showing us what this future looks like. You can lend money and earn yield without a bank. You can trade assets without a broker. You can insure risks without an insurance company. The total value locked in DeFi protocols has grown from zero to over $200 billion in just 5 years. That's not speculation. That's actual economic activity happening on blockchain networks. The believers will also tell you about network effects. Bitcoin's network processes over 300,000 transactions per day. Ethereum hosts thousands of decentralized applications. These networks become more valuable as more people use them, just like the internet became more valuable as more people got online. And unlike the dot-com bubble, where companies were burning cash with no revenue model, these blockchain networks generate real fees from real economic activity. Here's where the institutional argument gets really interesting. The same hedge funds and investment banks that I mentioned were reducing exposure, many of them are simultaneously building crypto infrastructure. Goldman Sachs has a crypto trading desk. JP Morgan has their own blockchain network. Fidelity offers crypto custody services. BlackRock just launched a Bitcoin ETF. These aren't the actions of firms that think crypto is going to zero. The macroeconomic picture supports the bulls too. We're living through the greatest money monetary expansion in human history. M2 money supply in the US has increased by 40% since 2020. Similar patterns are happening worldwide. When you're printing money this fast, when you're running trillion-dollar deficits, when debt-to-GDP ratios are hitting all-time highs, hard assets tend to outperform. And Bitcoin, with its fixed supply, is the hardest asset ever created. The generational shift is undeniable. Millennials and Gen Z, who will inherit $68 trillion over the next 25 years, are already allocating significant portions of their wealth to crypto. A recent survey showed that 67% of millionaires under 40 own cryptocurrency. These aren't day traders or speculators. These are the future leaders of business and finance, and they're voting with their wallets. The regulatory picture, which used to be crypto's biggest threat, is actually becoming a tailwind. The US has approved Bitcoin ETFs. The European Union has clear crypto regulations. Singapore, Switzerland, and other financial centers are welcoming crypto businesses. Instead of banning cryptocurrency, most governments are figuring out how to tax and regulate it, which legitimizes the entire space. Even the environmental concerns that plague Bitcoin are being addressed. The network is increasingly powered by renewable energy. Mining operations are moving to locations with excess clean power, and newer blockchain networks use a fraction of Bitcoin's energy while providing similar functionality. The believers have an answer for every criticism. Market manipulation? Traditional markets have plenty of that too. Volatility? The internet stocks were volatile during their early adoption phase. Lack of intrinsic value? The US dollar isn't backed by anything either, and it's the world's reserve currency purely because people believe in it. They'll point to the Lightning Network solving Bitcoin's scalability issues. They'll show you how Ethereum is becoming more energy efficient with proof of stake. They'll explain how central bank digital currencies will actually increase demand for decentralized alternatives. They'll demonstrate how stable coins are already being used for international trade and remittances. The venture capital money tells a compelling story too. In 2024, crypto startups raised over $30 billion in venture funding. These aren't retail investors buying meme coins. These are sophisticated investors with decades of experience backing the companies they believe will define the next era of finance and technology. The bulls also have history on their side, at least if you zoom out far enough. Bitcoin has crashed 80% or more multiple times, only to come back stronger. It fell from 20,000 to 3,000, then climbed to 69,000. It dropped from 69,000 to 16,000, and now it's testing new highs again. Every time the bears declare it dead, it resurrects with a vengeance. The stock-to-flow models, the network value models, the adoption curves, they all point to much higher prices ahead. Some respected analysts are calling for Bitcoin at $500,000 within a decade. They're not talking about speculation anymore. They're talking about Bitcoin becoming a global reserve asset, a digital gold for the internet age. And here's perhaps their strongest argument: we're still early. Less than 5% of the world's population owns cryptocurrency. If adoption reaches even 20%, still less than internet or smartphone penetration, we're looking at a market that's 4 times larger than today. Basic supply and demand economics suggests that means much higher prices. The institutional infrastructure is finally maturing. Crypto custody is becoming safer and more sophisticated. Regulatory clarity is improving. Traditional financial services are integrating crypto offerings. The technical hurdles that kept institutional money away are being solved one by one. So when the crypto optimists look at a potential 91% crash, they don't see disaster. They see the buying opportunity of a lifetime. They see a chance to accumulate assets that could be worth 10 times more in a decade. They see temporary volatility in a technology that's going to reshape the global financial system. Their logic is seductive. If you believe that digital assets are the future, if you believe that decentralized networks will eventually replace centralized intermediaries, if you believe that hard money will outperform fiat currency over time, then any crash is just a temporary setback in an inevitable transition. These aren't stupid people making these arguments. Many of them are brilliant technologists, successful entrepreneurs, and seasoned investors. They've done their homework, they've studied the technology, and they've reached conclusions that sound reasonable when you're immersed in their world. But here's what I've learned from 40 years of watching smart people lose enormous amounts of money. Being right about the long-term potential of something doesn't mean you're right about its price today. And that's where we need to start asking some harder questions about what happens when belief meets reality, when innovation meets human psychology, and when the future meets the brutal mathematics of market cycles. What if the believers are wrong about timing? What if they're right about technology but wrong about adoption rates? What if they're correct about the eventual destination but catastrophically mistaken about the path to get there? Those are the questions that keep me up at night, and they should keep you up too if you have significant money in this space. The bulls make a compelling case, but every bubble in history was supported by compelling logic right up until the moment it wasn't. So what do you think? Are these the early stages of a financial financial revolution, or are we watching the final act of the greatest speculative mania in human history? Now let me tell you why every single argument you just heard is either incomplete, misleading, or dangerously wrong. And I'm going to do it using the same historical patterns, mathematical principles, and human psychology that have governed markets for centuries. Because while technology changes, human nature doesn't, and neither do the fundamental laws of economics. Let's start with that seductive scarcity argument. Yes, Bitcoin has a fixed supply of 21 million coins, but scarcity alone doesn't create value. It has to be scarcity of something people actually need. There are only 5 original copies of my high school yearbook in existence, making them incredibly scarce, but that doesn't make them valuable. The question isn't whether Bitcoin is scarce, it's whether Bitcoin is necessary. And here's where the crypto narrative starts to crumble. Bitcoin was supposed to be digital cash, a peer-to-peer payment system that would replace traditional money. 15 years later, almost nobody uses it to buy anything. The average Bitcoin transaction costs $12 and takes 40 minutes to confirm. Compare that to Venmo, Zelle, or any modern payment app that moves money instantly for free. Bitcoin has already lost the payments war before most people even realized there was a war happening. But the believers pivoted. Now Bitcoin isn't digital cash, it's digital gold, a store of value. Except gold has been a store of value for 5,000 years across every civilization on Earth. Gold has industrial uses, jewelry demand, and cultural significance that spans millennia. Bitcoin has been around for 15 years and its only use case is speculation. Calling Bitcoin digital gold is like calling a Tesla a digital horse because they both provide transportation. Let's talk about those adoption curves that sound so impressive. 400 million crypto users worldwide sounds massive until you realize that most of them aren't actually using crypto for anything productive. They're buying it, holding it, and hoping it goes up in price. That's not adoption, that's speculation. Real adoption means people using crypto to solve real problems in their daily lives, and by that measure, crypto adoption is virtually non-existent. The institutional adoption story is even more misleading. Yes, some companies bought Bitcoin for their treasuries, but look what happened to them. MicroStrategy stock trades like a leveraged Bitcoin ETF now, not like a software company. Tesla sold most of their Bitcoin holdings. The companies that went all in on crypto have seen their core businesses suffer because management got distracted by get-rich-quick schemes instead of focusing on what they actually do well. As for countries adopting Bitcoin, let's look at how that's actually working out. El Salvador bought Bitcoin at an average price of around $43,000. At current prices, they're sitting on massive losses that represent real money their citizens desperately need for infrastructure, education, and healthcare. When a developing country gambles its treasury on a speculative asset, that's not validation, that's a cautionary tale about what happens when politics meets cryptocurrency mania. The technology arguments sound impressive until you examine them closely. Yes, blockchain can move money faster than traditional banking, but so can existing payment networks when they're not artificially slowed down by regulations and legacy systems. The real innovation isn't blockchain, it's removing intermediaries. But you don't need cryptocurrency to remove intermediaries. You just need better software and updated regulations. Decentralized finance sounds revolutionary until you realize it's just traditional finance with extra steps and no consumer protections. You can lend money and earn yield without a bank, sure, but when something goes wrong, and things go wrong all the time in DeFi, there's no deposit insurance, no customer service, and no legal recourse. You're trading proven consumer protections for slightly higher yields and the privilege of being your own IT department. Here's what really bothers me about the institutional argument. The same banks and hedge funds that crypto advocates point to as validation are the same institutions that will dump their holdings the moment market conditions deteriorate. These aren't true believers, they're momentum traders with better suits. When the next liquidity crisis hits, when pension funds need cash, when leveraged positions get margin called, institutional crypto holdings will be the first thing to get sold because they're the most liquid and least essential assets on their books. The macroeconomic argument about money printing actually works against crypto, not for it. Yes, central banks are printing money, but that printed money isn't flowing into crypto in any sustainable way. It's flowing into real estate, stocks, and other productive assets that generate cash flows. When monetary policy eventually tightens, and it always does, speculative assets like crypto get hit first and hardest because they don't produce anything. They're purely dependent on the greater fool theory. Let me give you a thought experiment that illustrates the fundamental problem with crypto valuations. Imagine I created a new cryptocurrency called Dalio coin. I programmed it to have perfect scarcity, only 1 million coins will ever exist. I built impressive technology around it, got some celebrity endorsements, and convinced a few hedge funds to buy some. I even got El Salvador to make it legal tender alongside Bitcoin. Now, what should Dalio coin be worth? The crypto logic says it should be worth whatever people are willing to pay for it based on scarcity, adoption, and network effects. But the traditional finance logic asks a different question. What cash flows does Dalio coin generate? What problems does it solve that can't be solved more efficiently by existing technologies? What happens to its value when the hype cycle ends and people start asking practical questions about utility? This thought experiment reveals the core delusion driving crypto valuations. Price is being determined by narrative and speculation, not by fundamental economic value. And every time in history that markets have detached from fundamentals for extended periods, the eventual reconnection has been swift, brutal, and devastating for anyone caught holding overvalued assets. The generational argument is particularly troubling because it preys on young people who don't remember what financial catastrophes look like. Yes, millennials and Gen Z are buying crypto, but they're also the generations with the least investment experience, the highest debt levels, and the most exposure to social media-driven financial advice. When I see young people mortgaging their futures based on TikTok investment tips, I don't see sophisticated adoption. I see a generation being systematically deceived by people who profit from their naivety. The regulatory clarity that crypto advocates celebrate is actually setting up the conditions for the crash I'm predicting. Clear regulations mean clear tax obligations, clear reporting requirements, and clear legal frameworks for enforcement. When the crypto market implodes, when people lose their life savings, when pension funds take massive write-downs, there will be political pressure for much stricter regulations. The current friendly regulatory environment is the calm before the storm. Let's address the environmental argument directly. Yes, Bitcoin mining is increasingly powered by renewable energy, but that's actually an economic problem, not an environmental solution. Bitcoin mining consumes as much electricity as entire countries, and that electricity has to come from somewhere. When crypto miners bid up the price of renewable energy, they're making clean power more expensive for everyone else. The environmental cost isn't just the direct energy consumption, it's the opportunity cost of renewable energy that could be powering hospitals, schools, and homes instead of solving useless mathematical puzzles. The venture capital funding argument reveals another fundamental misconception. Venture capitalists aren't investing in crypto because they believe the current prices are justified. They're investing because they think they can find greater fools to buy their positions at higher prices later. VCs have limited partners they need to satisfy, and those limited partners are expecting unrealistic returns based on the artificial gains from years of easy monetary policy. Crypto investing isn't driven by rational analysis. It's driven by the desperate need to generate returns in a world where traditional investments can't meet inflated expectations. The historical comparison to previous Bitcoin crashes is meaningless because the circumstances are completely different now. Previous crashes happened when crypto was a niche asset class with tiny market capitalization and almost no mainstream adoption. Now we have pension funds, university endowments, and retail investors with significant exposure. The scale of potential damage is exponentially larger, and the recovery dynamics will be completely different when institutional investors are forced sellers rather than opportunistic buyers. Those stock-to-flow models and network value models that predict Bitcoin at $500,000, they're the modern equivalent of the new economy valuation models that justified Pets.com trading at 100 times revenue. Mathematical models are only as good as their assumptions, and when the assumptions are based on perpetual exponential growth in a world of finite resources and human attention, the models become elaborate justifications for wishful thinking. The "we're still early" argument is the most dangerous of all because it can justify any price at any time. Enron investors thought they were early too. .com investors knew they were early. Real estate speculators in 2006 were convinced they were early. Being early to a legitimate trend doesn't protect you from being catastrophically wrong about timing and valuation. And in financial markets, being wrong about timing is indistinguishable from being wrong about everything. Here's what the crypto enthusiasts don't understand about market cycles. Bubbles don't burst because people suddenly realize the underlying technology is worthless. They burst because the price gets so disconnected from reality that even small changes in sentiment or liquidity can trigger massive selling cascades. When leveraged positions start unwinding, when margin calls start hitting, when institutional investors need to raise cash, the underlying technology becomes irrelevant. All that matters is supply and demand, and in a panic, supply always overwhelms demand. The crypto market today shows every characteristic of a late-stage bubble. Extreme valuations based on future potential rather than current utility. Widespread participation by unsophisticated investors. Celebrity endorsements and social media hype. Complex financial instruments built on top of speculative assets. dismissal of traditional valuation methods as outdated, and most tellingly, the absolute conviction among believers that anyone who doesn't understand crypto is simply too old, too conservative, or too ignorant to see the obvious truth. I've seen this pattern so many times that I can practically predict the next phases. First, there will be a period where prices remain elevated despite growing skepticism, convincing the true believers that the skeptics are wrong. Then there will be a catalyst, could be regulatory action, could be a major exchange collapse, could be broader market stress, that triggers the first wave of selling. That selling will reveal just how much leverage is hidden in the system, which will trigger more selling, which will trigger more margin calls, which will trigger even more selling. The crash won't be orderly. It won't give people time to get out. It will happen over days or weeks, not months or years. And when it's over, when 91.7% of the value has been destroyed, the survivors will be left wondering how they could have been so blind to such obvious warning signs. But here's the thing that really keeps me up at night. This crash won't just hurt crypto investors. It will hurt anyone whose pension fund, whose endowment, whose insurance company got caught up in the mania. It will hurt young people who sacrificed their educations and career development to day trade digital tokens. It will hurt developing countries whose governments gambled their treasuries on speculative assets. The collateral damage will be enormous, and it will fall hardest on the people who could least afford to lose. So when crypto advocates ask me why I'm so focused on warning people instead of just staying quiet and letting the market decide, the answer is simple: because I've lived through enough financial disasters to know that the cost isn't just measured in money. It's measured in broken dreams, ruined retirements, and lost opportunities for an entire generation of people who trusted the wrong experts at the wrong time. The question isn't whether some form of digital currency might eventually play a role in the global financial system. The question is whether current crypto prices bear any relationship to economic reality, and whether the people buying at these levels understand the magnitude of risk they're taking. If you've been wondering whether the skeptics might have a point worth considering, whether maybe it's time to take some profits and reduce your exposure, then shouldn't you be following analysis that's willing to challenge the consensus instead of just confirming what everyone wants to hear? After 40 years of studying market cycles, I've learned that the truth usually lies somewhere between the extremes. The crypto believers aren't completely wrong. Blockchain technology will likely transform certain aspects of finance and commerce, but they're catastrophically wrong about timing, valuation, and risk. The harsh reality is that most revolutionary technologies go through a hype cycle that destroys early investors before creating long-term value. The internet was revolutionary, but that didn't save investors who bought pets.com at peak valuations. Railways transformed civilization, but that didn't help the people who bought railway stocks during the 1840s mania. Crypto will follow the same pattern. Here's my final insight. The 91.7% crash I'm predicting isn't the end of crypto, it's the beginning of its real utility. When the speculation is wrung out, when the leverage is cleared, when prices reflect actual use cases rather than wishful thinking, then and only then will we see what blockchain technology can actually accomplish. The survivors of this coming crash will be the builders, not the speculators. The people solving real problems, not the ones chasing quick profits. The institutions that approach crypto as technology, not as a get-rich-quick scheme. The investors who understand that innovation and speculation are two completely different things. But until that cleansing happens, until the market reconnects with reality, we're living in a dangerous fantasy where digital tokens with no cash flows trade for more than entire corporations with billions in revenue. That's not sustainable, it's not rational, and it's not going to end well. So here's what I want you to remember when the crypto cheerleaders tell you this time is different, when they promise you generational wealth if you just hold through the volatility, when they dismiss concerns about valuation as outdated thinking. Every bubble in history was supported by smart people who believed they had discovered something new under the sun. But markets aren't new. Human nature isn't new. And the laws of economics aren't optional just because we're dealing with digital assets instead of physical ones. The choice is yours. You can listen to the people who profit from your optimism, or you can prepare for what history suggests is coming. You can believe in revolutionary transformation, or you can protect yourself from revolutionary destruction. You can hope this time is different, or you can remember that it never is. The crash is coming. The only questions are when, how fast, and whether you'll be ready for it. After hearing both sides of this story, where do you stand on the biggest financial decision of our time?